Hello and welcome back. So in this video, we're gonna just be talking about in the money versus out of the money. So again, in the money is a little bit less risky compared to the out of the money. So you'd be paying a little bit more for in the money, but you're playing a little bit safer compared to out of the money. So out of the money might be enticing just because it could be a little bit cheaper, but you just have to be careful. And we're just going to take an example and look at one in the money. So again, if you remember from the previous, in the money is in this like blue shaded, which again is any price from $0 to the current price, which is currently $121. Out of the money is the current price, so $121, and anything above 121. So 122 onward is out of the money. So what we're going to do is we're actually going to look at, we're going to take the 118th call for $4.10, and we're going to look at the 124 call for 94 cents. The theta is roughly is 14 for the 118 and roughly 13 for the 124. So I'm going to go into an example. So you can see right here, again, we're looking at the 118 call for $4.10, which is going to cost you $410. Again, remember, it's always multiplied by 100. Out of the money call, the 124 call in this example is 94 cents or $94. And so again, this is for the March 19th. It's expiring in that 6 days. So theta, we'll say it's roughly 14 cents for both. The in the money was 14, out of the money was 13, but we'll just do 14 for this example. It's gonna be pretty close. So again, theta, from if you remember from the last video, theta is how much your contract decays overnight if Apple opens up at the same price. So in this example, Apple opens up at $121 again at the current price. Theta, you're gonna lose $14 on the contract, right? So we're looking at the 118 call. So now your contract the next day will be worth $396 or roughly 3% loss. So again, the 396 comes from $14 minus 410. So $410 minus $14 is 396. So again, theta is also multiplied by 100. But now let's look at the out of the money 124 calls. So now it's actually going to be worth $80 because it's 94 minus $14, which is $80. And you're roughly down 15%. So just on the same theta, your 124 out of the money call is down 15%, which is a lot compared to that 3%. So that's why usually it's better to pay a little bit more for this in the money calls compared to the out of the money calls, because even if Apple stays the same at $121 the next day, you're only going to be losing 3% versus 15%. So hopefully this is making a little bit sense. You're understanding Greeks a little bit more and how to actually kind of look and compare the calls compared in the money versus out of the money.